Welcome to this video tutorial on the Berry ratio. We're going to begin by talking about the definition of the Berry ratio, how it's calculated, and what can affect it. In this slide you can see the definition of the Berry ratio. It's equal to essentially the gross profit divided by the operating expenses. And mathematically in this formula we think of the gross profit as the revenues, which is the price times the quantity of goods you sold, less the COGS, and that divided by OE for the operating expenses. Now, when you use this transfer pricing profit level indicator, where is the transfer price going to be affecting this equation? Well, generally, it's going to be in the COGS. A Berry ratio is normally used for a distributor, and it's used in some very special cases of distributors, those in which the variation in the ratio of operating expense to COGS is affecting how you're perceiving the profitability relative to the services rendered most commonly. So if this is how you're measuring your profit level indicator, what are things that could undermine this profit level indicator as a tool to determine if pricing meets the arm's length standard? One of the first issues that comes into play when looking at the Berry ratio is to ask the question of whether the costs separation into COGS and operating expenses might be different from that of the comparables. If there's a difference in that decision as to how a certain expense ought to be allocated to one or the other, it'll be moving an item from the numerator to the denominator, and you'll get variation in the Berry ratio, not that as a result from normal variation in arm's length pricing, but from a difference in accounting standards that two different firms might be employing. This kind of problem can usually be addressed by carefully looking at the 10Ks into the notes of the financial statements and determining how various specific costs are being handled, and adjustments can normally be made. One of the other issues that can affect the Berry ratio is if the transfer price, that portion of COGS that's from a related party, is only a small portion of total costs. In this case, you'd be looking at a transaction in which the fluctuations in the related party price might be swamped by transactions with unrelated parties that are other sources of other suppliers or other sources of your COGS. This first item that we've mentioned up here would actually distort the measure and could cause you to draw a wrong conclusion. The second item is more likely to just make it insensitive, and you may need to look at a different approach to the transfer pricing that would improve the sensitivity of the profit level indicator to changes in the transfer price. Thank you.